Well, a whole slew of economic data was released on Monday morning, from the Federal Reserve's preferred inflation gauge to the latest reading on personal income. For reaction, I'm joined on set by Anthony Chan, Chief Economist at JPMorgan Chase. And Anthony, it's great to have you here. Welcome.
Glad to be back.
So core PCE rose 1.2% over the past year. It's still far from the Fed's 2% target. What's your take on inflation, and is this a bad sign for the rest of the second quarter?
Inflation so far is still not an issue, but as you probably know, the difference between core PCE and, say, core CPI is always anywhere from 4 to 0.6%. Obviously, because of the weight they weight things. Housing takes a much smaller share. Medical takes a much broader share in the core PCE. So there are differences in the way these indices are constructed. But given the fact that the Federal Reserve has made it very clear that they target core PCE, it really says that there is no urgency for the Fed to move.
Okay, and speaking of that, do you think the Fed will lift rates higher in September?
I think that they will probably lift rates either in September or perhaps a little bit later, because part of the personal income report, you basically saw no consumer spending, even though there was an upper revision to the prior month. It's sort of like throwing a party and consumers forgot to come. A lot of them got dressed because you got a slight upward revision in the prior month, but very few actually came to the party. So given that as a backdrop, I think that the Federal Reserve can either go in September or perhaps even wait a little bit longer and maybe go in December.
Okay, because there are plenty of economists out there who say, look, the economic data out there just doesn't warrant a 2015 rate hike. So what about lifting in 2016?
I think that the economic data does in fact justify it. If you look at employment growth, if you look at the unemployment rate, there are a lot of things out there that no longer tell us that this is sort of a panic situation when the unemployment rate was at 10%. So that when the unemployment rate goes down to 5.4%, and by the way, continuing to come down, and very soon I think will even go down to 5%, you can no longer justify a 0% interest rate. It's not the same world where you had double-digit unemployment rates by any stretch of the imagination.
All right, let's talk about the state of the consumer. Personal income rose 0.4% in April. Now, according to the Federal Reserve's household survey, about a third of respondents think their income is actually going to go up over the next year. But we're also seeing consumers not spending some of that extra money. They're saving it instead. Does that worry you?
The savings rate picking up in this latest personal income report is a little disturbing, but that's a monthly number, and we know there's a lot of volatility surrounding this. The fact that personal income was so strong, a little stronger than the market was expecting, is somewhat encouraging, and if it's followed through by much faster employment growth, I think it's just a matter of time before consumers actually go out there and start spending money. But if these savings rates continue to go up, of course it's alarming, and it will be alarming to policymakers.
Because they haven't been spending the stimulus at the pump, the gas pump.
Well, I think that in this year, for example, they haven't. But if you look at last year, in the fourth quarter of last year, consumer spending rose 4.4% when the economy was growing at 2.2%. Even if you look at the first quarter anemic number, 1.8% consumer spending is nothing to sneeze at, given the fact that the economy contracted by 0.7%. So consumers are doing more than is justified by the overall growth in the economy. But you're absolutely right. They could be doing a lot more, given all the stimulus they've gotten from lower energy prices. And in fact, that wealth effect from the equity markets.
All right, Anthony, we'll leave it there. Anthony Chan, Chief Economist at JPMorgan Chase. Thanks very much for coming in.
Pleasure.
I'm Scott Gamm, and you're watching The Street.